Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving deep into LandBridge Company LLC. Or help me.
Right.
They're a really unique and I'd say increasingly specialized player operating across energy, infrastructure, and now the digital sectors of the mighty Permian Basin.
And this company presents a fascinating, really acute conflict for investors. LandBridge is a capital-light toll road betting that it's almost unbelievable 88% adjusted EBITDA margin and $50.8 million Q3 revenue, up 78% year over year.
Which are just staggering numbers.
They are. They're betting that all of that will justify its 33x adjusted EBITDA valuation against the really strong headwinds of a multi-year timeline. We're talking out to 2029 for its digital optionality and the constant volatility of a lower for longer WTI environment.
That ratio, 33 times, that is the challenge. And it's exactly why this deep dive is so critical. We really need to unpack how a company like this, with such high execution hurdles and a vision that stretches half a decade, can manage to earn that kind of market confidence today.
And the answer, I think, lies not just in the high growth, but really in the quality of those margins and the long-term strategic vision that's baked into their physical assets.
Okay, so let's start with the immediate proof. The recent quarterly results, you called it a financial shock, and when you look at the Q3 2025 execution, I mean, it is hard to argue with that.
It really is. The raw top-line numbers are undeniably impressive.
So what are we looking at?
LandBridge reported revenue of $50.8 million for the third quarter of 2025.
$50.8 million.
And that marks a robust 78% year-over-year increase. To put that in context, achieving almost 80% revenue growth in what people see as a mature industry, well, it's spectacular.
It's incredible, but you're saying that's only half the story.
It is. The other half is the almost miraculous profitability they pull from that revenue.
And that's where this structural genius, this capital-light toll road idea, really kicks in. How does that actually translate into hard numbers?
It's all in the adjusted EBITDA profile. That's where this company really sets itself apart. Adjusted EBITDA hit $44.9 million for the quarter, which is up 79% year over year. So it's practically keeping perfect pace with that top-line revenue growth.
So when you net those two out,
you get an extraordinary 88% adjusted EBITDA margin.
88%.
Yeah. I mean, think about what that means. LandBridge's revenue comes from licensing its land surface use agreements, easements, water disposal royalties. Their partners, the E&P companies, the midstream operators, the future data center builders.
They're the ones spending the big money.
They bear the massive capital expenditures.
Yeah.
Exactly. They build and operate the infrastructure on the land. LandBridge just collects a fee for access.
So they're shielded from that huge CapEx burden that just crushes traditional energy companies.
Completely. And it lets them convert nearly every single dollar of revenue into profit.
Yeah.
This ultra-high efficiency is their core business moat, without a doubt.
Okay, so if the moat is offloading CapEx, the obvious question is that margin durable? I mean, we're talking about the Permian. It's an energy market. It's exposed to these wild commodity swings. What's stopping a crash in WTI prices from derailing this?
The protection is engineered directly into their revenue mix. And it's the key reason they get an infrastructure multiple, not an energy multiple.
That's right.
In Q3 2025, a staggering 93% of the revenue came from non-oil and gas royalties.
93%.
And we saw this play out perfectly this quarter. Their direct oil and gas royalties, they actually declined sequentially.
Well,
went from $4.5 million down to $3.4 million.
why was that?
It was a mix of dipping oil prices and a production decline from about 11,199 BOE per day down to 923.
And this is the key point.
It almost didn't matter.
It was almost irrelevant to the core thesis because those O&G royalties are less than 10% of their total revenue now. That aggressive diversification into water management and resource sales, it's their insulation against commodity prices. That really does make the margin structure sound incredibly robust. So let's shift to financial stability. Managing leverage is always a choice, especially when you're prioritizing growth. What's the balance sheet telling us about risk?
Well, they're generating strong GAAP results, first off. $20.3 million in net income for the quarter.
Okay, solid bottom line.
Very solid. But the real stability story is in their debt management. They use leverage, for sure, but they do it to fund accretive growth, and they do it within these really disciplined guardrails.
So what are we looking at?
They successfully lowered their net debt to covenant EBITDA ratio to 2.2 times as of September 30th, 2025.
And maybe you can elaborate just a bit for our listener. Why does that specific 2.2x number matter so much?
It matters because it signifies discipline. A covenant EBITDA ratio is what a company agrees with its banks to make sure it doesn't get over-levered. Their stated target range is 2.0x to 2.5x.
So they're right in the sweet spot.
Perfectly in the sweet spot. They're managing risk, but they're still using the capital markets to aggressively go after acquisitions. It's a very different philosophy from, a company that's aiming for zero debt.
And despite these controls, management hasn't slowed down their growth expectations at all. They reaffirmed guidance for the full year.
Not one bit. They maintained a very bullish full-year outlook. The midpoint of their guidance for Adjusted EBITDA is between $165 million and $175 million.
And what was that for 2024, just for comparison?
2024 EBITDA was around $97 million. So meeting this guidance implies more than 70% growth year over year.
Wow.
It requires flawless execution, no doubt. But the momentum from those non-commodity contracts, it absolutely supports that trajectory.
Okay, that robust outlook brings us right to the competitive arena. I mean, when you talk about land ownership in the Permian, the comparison is always inevitably to Texas Pacific Land, TPL. So we know LB is high margin and diversified, but how does its physical and operational structure really give it a cleaner strategic path than TPL?
The dynamic is all about the physical asset itself, and then the revenue that comes from it. LB's #1 competitive advantage is its contiguous land holdings. They expect to reach about 300,000 acres after this latest acquisition.
And contiguous is really the key word there, isn't it?
It's the operative word. This concentrated, uninterrupted surface ownership makes LB the ideal and sometimes the only partner for these massive, complex infrastructure projects. Think multi-county pipelines, new power lines, or huge side-by-side data center campuses.
Right, I think you used an analogy before. It's like building a highway straight through a single state versus trying to connect a bunch of scattered parking lots across a city.
That's exactly it. TPL, on the other hand, operates with this highly fragmented checkerboard pattern of land. They own a ton of acreage, but that fragmentation creates huge legal and engineering complexity for any large-scale development.
Your costs and timeline just explode.
They skyrocket. LB's land simplifies all of that. It eliminates those friction costs for the counterparty, which is absolutely crucial for their data center and power strategy.
And that physical difference, the contiguous versus checkerboard, it translates directly into their revenue exposure.
Absolutely. It's the sharpest contrast between them. LB has made a deliberate pivot to focus almost entirely on surface infrastructure. Water management, easements, digital facilities. They keep their direct O&G royalty exposure under that 10% mark.
Whereas TPL,
while it's highly efficient, is still very reliant on the traditional oil and gas industry. Their O&G royalties make up between 50% and 57% of their total revenue.
So TPL is still fundamentally tethered to the volatility of WTI prices.
Yeah.
LB has managed to structurally insulate itself. It's acting like a true infrastructure landlord.
That is the key difference, and you see it in their financial architecture, too. TPL is famous for its zero financial bet position. They prioritize absolute safety.
Right.
LB, on the other hand, even while looking at a phenomenal normalized free cash flow margin near 90%, consciously uses strategic leverage. They target that 2.0x to 2.5x net debt ratio to accelerate growth.
So it's a philosophical choice.
It's a deliberate choice. TPL maximizes safety and distributes cash. LB maximizes growth and capital efficiency to go after these truly transformative opportunities.
Okay, so let's get into those transformative opportunities. The non-oil growth drivers that are pushing that high valuation. You mentioned two major strategic moats. The first, and maybe the most immediate revenue driver, is water. The Permian's biggest bottleneck isn't getting oil out of the ground anymore. It's what to do with all the water that comes with it. How is LB using its land to create a moat here?
This is where we get into subsurface ownership, specifically something called pore space.
Rich space.
And the strategic asset here was legally fortified by the 2025 Texas Supreme Court ruling in the Myers-Woodward case. That ruling definitively reinforced that the pore space, the subsurface storage capacity you need for water disposal and carbon sequestration, belongs to the surface owner.
And why was that ruling so critical? Was it legally ambiguous before that?
Very ambiguous. For decades, all the legal focus was on who owned the mineral rights. The surface was just seen as access. But as water disposal became the bottleneck, the value of the non-mineral subsurface, the actual holes and voids you need to inject and store water, it just skyrocketed.
So this ruling solidified their position.
It did. It ensured that since they own the contiguous surface, they legally control the disposal capacity right beneath it. It's a massive, permanent legal moat, especially against operators who only own mineral rights but desperately need a place to put their water.
So given that legal moat, what is the physical scale we're talking about? This isn't just a few small disposal wells, is it?
Oh no, this is industrial basin critical scale. LandBridge has permitted capacity of more than 5+ million barrels per day of pore space.
5 million barrels a day.
Per day. And to put that in context, this capacity is mission critical because drilling in the Delaware Basin generates these staggering amounts of toxic water. We're talking 4 to 10 barrels of water for every single barrel of oil.
So if you can't get rid of the water,
You cannot drill, period. It makes water management the single biggest bottleneck in the American energy industry. The source material describes producers as panicking to secure future pore space capacity years in advance.
which gives LB huge pricing power.
And unparalleled long-term contract visibility.
That really does frame the water business as an unavoidable toll road. Okay, let's pivot to the second major moat, the one that gets the market really excited and drives that high valuation. The powered land strategy. Digital infrastructure, AI revolution. Why is the remote Permian Basin suddenly the perfect place for these power-hungry data centers?
It's the perfect convergence of resources that the traditional data center hubs, like on the coasts, are running out of. And that's dirt cheap power and cooling.
Okay.
The Permian is one of the only places that offers both dirt cheap natural gas, often trading at zero or even negative prices because of takeaway issues, and nearly limitless cooling water, which they can get from treated produced water.
So explain the economics of that. How does cheap gas give a data center such a massive advantage?
Well, these hyperscale AI data centers consume enormous amounts of power, like a small city. Their biggest operating cost is electricity. So when LB can provide land where a partner can build a dedicated power plant right next door.
Powered by that practically free gas.
Exactly. They capture the arbitrage between the cost of that gas and the price of power. They bypass the congested grid. They eliminate transport costs. The data center operator gets power at a cost far below what's possible anywhere else.
And LandBridge isn't just talking about this in theory, right? They've already started to commercialize it.
Precisely. They announced a really significant strategic collaboration with NRG Energy to explore developing a potential data center site. And that includes possibly building an adjacent 1,100 megawatt natural gas power generation facility.
1,100 megawatts. That's the size of a major conventional power plant.
It is. And facilitating that is the critical step in monetizing the powered land thesis. They've also already received an $8 million lease development payment for an initial data center project last year.
But that brings up the timeline. That 1,100 milliW vision is monumental, but the earliest in-service date is year-end 2029. That is a long runway.
It's a very long lead time, 5 years from now, but it really underscores the scale of the multi-billion-dollar opportunity. These projects take years of permitting, studies, and construction. The market is valuing the company today on the assumption that this structural advantage will materialize.
Okay, speaking of immediate value, let's shift from that 5-year vision to the tangible earnings they need to defend a 33x valuation today. What's the most immediate growth driver on the horizon?
The most immediate impactful catalyst is the recent 1918 ranch acquisition. It closed in November of 2025. This deal added 37,500 acres across several key counties, strengthening that contiguous footprint.
And what does that mean for the bottom line?
Management's being conservative, but they're clear. This acquisition alone is expected to contribute an immediate $20 million to 2026 Adjusted EBITDA, and that's based just on current run rates.
So revenue from existing contracts on that new land.
Exactly. And just like their original holdings, this acquisition compounds that poor space moat. It added roughly 900,000 barrels per day of incremental pore space capacity, specifically on their eastern footprint.
And that's where the layered growth comes in.
That's right. The immediate contribution is $20 million. But management believes this underutilized capacity, if they can fully commercialize it, could eventually generate mid-$50 million in annual EBITDA.
So that gap between 20 and 50 million, that's the upside they have to go out and capture through new contracts.
That's the active commercialization. It shows that even their core water business has this multi-year growth runway baked right in, projected on a 3 to 4 year timeline.
Okay, beyond acquisitions, the market needs external proof. Validation that smart blue-chip operators are actually signing up for this toll road years in advance. What have we seen?
We've seen two major commercial proofs. First, the Devon Energy 10-year surface use and pore space agreement, a 10-year deal. And importantly, it doesn't even start until the second quarter of 2027. It secures 300,000 barrels per day of pore space capacity with a huge minimum commitment of 175,000 barrels per day.
A major operator like Devon locking in capacity 2 years from now with a minimum volume. That's a serious vote of confidence.
It absolutely is. And the second validation is the Waterbridge Speedway Pipeline project. This is expected to generate a material $30 million in annual cash flow for LandBridge once it's fully operational.
And when do we see that start to kick in?
Contributions should start as early as late 2025 or early 2026. So it's a measurable near-term boost to their high-margin cash flow.
Okay, so we have a high-margin, contract-backed water and infrastructure company with real near-term growth. This brings us back to the multi-billion-dollar question. Is the market valuing the digital optionality on top of all that?
That is the central audacious point of the bullish thesis. The analyst consensus is that the market is valuing the water and the core infrastructure business strongly enough to support a conservative fair price target of $70 per share for that business alone.
So you're saying the entire digital data center thesis is
essentially for free. It's unpriced optionality.
Yes.
You're paying for a great infrastructure stock and getting a potential technology boom thrown in as a bonus.
So I have to challenge that a little. If the biggest upside is 5 years out, 2029, isn't the market demanding flawless execution for 5 years just to hold the current price? Why should an investor pay today for something that's so far away?
Because the sheer magnitude of the potential upside is so transformative. And the physical asset that enabled it, the land, the cheap power, it's finite and irreplaceable. Look at the scale. That single 1 gigawatt data center we talked about, built on just 2,000 acres, could represent an estimated $90 million in annual revenue for LandBridge.
$90 million from a single deal,
Right.
when their current quarterly revenue is $50 million. That is transformative.
It is. The revenue comes from the land lease, the royalty on the power spread, the water handling fees. The potential for multiple deals like that over the next decade is what turns this from a niche play into a high-tech asset play. And that's what underpins the bullish rationale.
Okay, we've laid out an overwhelming bullish case. The 88% margins, the differentiated land, the multi-billion-dollar opportunities. Now we have to weigh it against the risks that come with a high multiple stock. Does this unique blend justify that 33 times valuation?
The valuation is defensible if, and it's a big if the ultra-high margins and the non-commodity revenue mix hold true, and if they execute on that digital upside. But that high multiple puts immense pressure on flawless execution.
Right. Let's start with the foundation, commodity price risk. Even if LB is diversified, their customers are still oil companies.
Absolutely. Despite the 93% diversification, the health of the Permian is paramount. A prolonged, lower-for-longer environment, specifically with WTI below $70 a barrel, could deter new drilling. A slowdown in activity across the basin would inevitably pressure water volumes. LB is protected from price swings, but not from volume declines.
And then there's the execution risk tied directly to that massive digital upside.
The execution and timeline risk is arguably the biggest counterpoint. The 1,100 million power facility. That's a complex, multi-party, regulatory-intensive project. It has that long, volatile execution timeline out to 2029.
And any significant delay.
A failure to execute or even just multi-year delays could cause the market to completely deflate that growth multiple, leading to some really sharp corrections.
And we have to address the elephant in the room. The governance issues, the affiliation with Waterbridge and 5 Point has drawn significant fire from critics.
This is a major structural headwind. LandBridge faces serious allegations regarding related party revenue boosting. Critics estimate that between 16% and 55% of LB's 2024 revenue was suspect. They cite things like the $8 million data center deposit being recognized immediately as revenue. Critics argue they're transacting with affiliated entities at terms that might not be truly arm's length, potentially just to boost short-term revenue and hit targets.
So the concern isn't that the deals aren't real, but that the terms might be designed to benefit related parties.
Precisely. And this is amplified by their regulatory posture. They're currently using a temporary loophole for an emerging growth company, which means their auditor hasn't yet had to formally attest to the effectiveness of their internal financial controls.
So that lack of full audit coverage on controls, plus the related party controversy, that's fuel for the short sellers.
That's exactly what they use to justify their position. And this all manifests in the trading behavior.
Of course.
The heightened sentiment risk contributes directly to volatility. You see notable short interest at over 16% of the float. They're betting that the revenue growth is unsustainable or that the 2029 digital upside will inevitably falter.
So the final verdict for you as an investor is this choice. You're choosing between capitalizing on these unprecedented contract-backed margins from an essential water business and buying into a high multiple valuation that's really predicated on a speculative multi-year tech boom, all against this background of execution risk and governance scrutiny.
Exactly right. You are investing in a future where the Permian is redefined not just by oil, but by its capacity to solve two of the biggest industrial challenges we face, managing energy waste and meeting digital infrastructure needs. The whole thesis hinges on the idea that the water business defends the current price.
Right.
Well, that massive data center thesis is the unpriced optionality you get for free, provided you have the patience to wait for 2029 and the risk tolerance to overlook the noise.
What stands out to you, our listener, is just the incredible patience required to hold a stock whose biggest upside is 5 years in the making, and the courage it takes to invest in a company that is intentionally using leverage, facing public governance accusations, yet operating in an infrastructure sweet spot that is unlike any other in the world.
And the provocative thought to leave you with is this. If the ultra-high margin water business alone justifies that current $70 per share target, what multiple does the market eventually assign when the first 1 gigawatt data center is fully financed, under construction, and proven to be commercially sound, thus establishing that powered land thesis as an inevitable reality?
A truly fascinating thought experiment for anyone looking at the future intersection of energy and technology in the Permian Basin. Risk defined, portfolio protected.